So this has been a really fun series. We've been talking about what is the best design for an infinite banking policy. You see, there isn't a one best design. There's many best designs. The designs are all done to solve your problem, because that's really all we do. We solve your problem, your money problem. Because I once heard from somebody, they told me, they say, if you want your problem solved, go out and solve somebody else's problem. That's how it works. So we just got to solve your problem. And if solving your problem can't be just one path, well, then we had to recreate the whole vision for this. Now, I know Nelson Nash, as we started in this series with the Nelson-Nash model, we talked about the 60-40. Now, that model worked really well, and it still does, even by today's standards. He came up with that back in the late 90s, so you can see it's held the test of time. But we have elaborated on that. We've gone deeper into the designs, and we've been able to make them more efficient for some of your problem solves. Okay, so with that being said, we have now come to the final episode. And this one's unique, but I also got to be careful on how I explain this. We're going to talk about the rock. That's right. We're going to talk about a plan design that doesn't even exist if you talk to any other IBC practitioner or any other financial advisor or agent. They cannot do this, which is why I almost don't like talking about it, because it almost seems unfair. But what the heck? Sometimes life just isn't fair. And what we have done is we have literally gone to one of the main giant mutually owned insurance companies that we work with. We have got them to create a hybrid vehicle, a hybrid design that fits and fills a solution that we needed. Now, what is that solution? Remember we just talked about the 90-10, 90% to PUA, 10% to base, but I said how that will fail you in the later years. And then I told you how we created the Beast, which is 75-25, and the Nelson 60-40, and the Slayer 35-65, and how all of those were more efficient in the later years because it's all about the base. So here's what we did. We knew that most of our clients want as much of their cash value as they can get in the early years. That's not even in question. We know that you want that. But to get that, sometimes you got to give too much on the back end. You got to give too much base up till it hurts your later years and the efficiency in the policy. So here's what we did with the Rock, and that's why we call it the Rock. We literally got special authorization on a case-by-case basis. Now, let me preface this. It's very important for you to understand. The Rock is not going to work for everybody. Matter of fact, the Rock is only going to work for clients that are putting large amounts into the policy. Now, let me define that. This design, the Rock, will only work if you're putting a large dump-in into the policy. Let's just say a $100,000 dump-in or more. Don't ask for the Rock if it's less than $50,000 in dump-in. It's just not going to work for you. I'm sorry. But if you got 100 grand, 200, a million, 5 million, that you want that money to go to work for you, but you want access to that money, here's what the Rock does. If you've got that large dump-in, okay, what we can do is we can design the policy as a 90-10 in the first year only. Because really, most of you want to put a big dump-in in, you want access to the majority of that dump-in and your premium deposits right away. And you want all that money earning compounding interest. So 90% of your deposit in the first year goes into the paid-up edition. We can vary the base any way you want. We could do the base, we could do the Beast model, we could do 75-25 in years 2 through 10. We could do the Slayer, we could do 65-35, years 2 through 10. Or we could even do the Nelson model, years 2 through 10. That's the coolest part. It allows us to get our ice cream and eat it too. I think that's how they say it. We get to go 90-10, year 1, when you want the most amount of your cash value. And then we get to flip it years 2 through 10 to whatever blend we want of all the other ones. So literally, this brings everything together. But again, did I tell you, this will not work for everybody. There's a lot of ways the Rock still isn't working for us. Now, we're always trying to make it better, but for right now, if you're older, it's hard to make the Rock work. What do I mean by older? 65 or more, okay? And if you're really young, the Rock more than likely will not work for you. I'm not saying it can't, I just say we have to look at it. So the Rock is unique, okay, in its design, but it also has flaws. So it requires a large dump-in. It requires premium deposits that meet the MEC rules. So probably if you put 100 grand in, we got to put about 15 to 18,000 away per year, bare minimum. And by doing that, we're going to put 90% of all that money into the paid up additions year one. Year two, whatever amount you decide to put into the paid up additions and the base, it's going to flip. It's going to go to whatever model we decide to create. Now, in this example that I'm going to do in just a second, we're going to use the beast. Okay? We're going to do 75% paid up addition, 25% base from years 2 through 10 to make up this rock. Remember, year one is almost always going to be as close as we can get to 90-10. Now, in some scenarios, it might be 85-15, but I just want you to know the goal with the rock is that we put 90% into the paid up additions. But I also want to preface, in all examples, depending on the ratio between the dump in and the base, it might not be exactly 90-10. I'm just trying to prepare you. What I'm about to teach you with the rock, a lot of people love this, but you have to understand it's not perfect. Well, what the heck? Let's just dive in. But before we dive in, I'd like to ask a little favor. I could use a refill in, I like old fashions, or do you have any sour beers? Yeah, can you just get me a refill on that? And also, while he's getting me a refill, I'd like for you to click that little subscribe button right there. Yep, that one that just showed up. And while you're at it, nice throw, Rudolph. Rudolph's a boy, did you know that? So, you know, if you're ever talking to somebody about Rudolph and all the other reindeer, I just wanted you to know that Rudolph is indeed a boy deer. But while we're on the Rudolph thing, who just dropped this is that little bell. Smash that bell so that you can be notified every time we put new content out. Let's dive into the rock. Thank you, and cheers. We call this the rock. I got to give you a disclaimer here. This design is proprietary and only available to the Money Multiplier and Money School BYOB. Our clients are the only ones that can get this design. And not all of our clients can get this design. This design only works for people that are putting more money into the policy. You can't be doing a small starter policy. It's got to have a dump in first. We got to be doing a sizable dump in. Let's just call it $25,000 and up. Okay, the higher the dump in, the better this plan works. And we got to be putting at least $10,000 per year into the policy for this to work. Not only that, this requires a dump in for the deposit, and it has to be approved as an exception by this particular insurance company. So I don't want you to get super excited about the rock because it's not available for everybody. But if it is available for you and your goal is high early cash value with the maximum efficiency in the later years, boy, did we ever knock it out of the park. So again, let me just give you the inputs. 45-year-old healthy male. We're doing a $50,000 dump in the first year. And then we're only putting, we'll just call it 10 grand, but it's just for transparency, it's $9,999.48 because this plan is very difficult for us to design. So in designing this, it's not fun. But when we get it, it works really well. So how this design works, and I want you to stay with me because I just went over 4 other designs. This one is completely different. See, this design, in the first year, I'm going to put 10% into the base. So let's just call that, just for this is not exact, but let's just call that $1,000. Into the paid up addition, I'm going to put 90%. Let's just call that $9,000. So we remember that that's the best model for early cash value, but we couldn't do that model with the dump in. So then what we did is in the second year, so the first year, we're putting in the 50 grand and the $9,999. But in the second year, we're going to put the $9,999, but we're going to flip it. So year 2 through 10, we're going to take the base and the PUA and we're going to flip it. And we can do it any which way, but for this one, we're just going to say that the base is going to be 25% and the PUA is going to be 75%. But I can also design it so it's 60-40 if we really want the most efficient long term. It does require a term rider. So we do have a drag on here with the term rider, and that's because of the MEC 7 pay rule. The death benefit in this particular design is probably going to be one of the best ones. Now, there's some unique things about this, so I want to show that on this particular design with this particular insurance company, our death benefit in this one is going to be $1,196,142. See how that's way higher than the other ones? Well, it's because of the way this policy grows. And the other thing about this, the commission on this policy is going to be one of the lowest. It's going to be that of which the 90-10 was. That's how you have so much cash value early on. Our commission on this plan is going to be $28.9904. Why? Because we're only getting paid on 10% in the first year of the base. Because all of the switch happens year 2 through 10. You're only paid on first year premium deposits. Ding, ding, ding. We give, so you get. But look at the returns. In the first year, the 90% of the paid up addition gives us access to $55,000 of the 60 that went in. One of the best of all of them. In the 5th year, we put in 10 grand and we're taking 11,000 out. Our efficiency point is the 3rd year in this design. Every year after year 3, we're printing money. Not really, but we're making more than what we put in. 10th year, we put 10 in, we take 14 out. The 15th year, we're gonna drop down to 2264. So it's about 22%. So it's a little off, okay, but just take that. 2264, look at this. In the 15th year, I put 2264 in and I take 9,600 out. In the 20th year, I put 2,200 in, I take 11,518 out. Shut the front door. Oh, I'm just counting the money that I just made you. That's right, because this isn't my money, it's your money. I just wanted to make sure that it was all there and accounted for. We have literally just dissected the infinite banking concept plan designs. How we design these specially designed and engineered whole life policies. We gave you all the secret sauce. We showed you exactly how this works. And we broke it down and went behind the curtain on all of this. A lot of other agents and advisors that are trying to do this will be really upset that I just showed you this because I just took their commission away. I gave it to you. That's right. I gave you all of their commission. So you thought I was counting your money. I was. But where did your money come from? The other agents' commission checks. That's right, because that's what we did. This whole thing works so well because one person gives so that you get. That's right. In order for any of these designs to work, the person writing the policy, which is usually going to be us at the Money Multiplier, we're going to design the policies because clearly, like, this is what we do and the only thing we do. We're going to design them, and every one of these policy designs is going to result in a 60 to as much as 90% reduction in how much commission we get. I know, it's cool, right? You get the money. So if our commission gets reduced by 60%, you have 60% more. If our commission gets reduced by 75%, you have 75% more. If our commission gets reduced by 90%, you have 90% more. That's the trade-off. Someone has to give, so somebody else gets. So with a little bit of that give-take, because we give so much to you, over 7,000, almost, I think we're approaching 8,000 clients in the United States. So over 7,000 people we have gave to. So I need you to give a little something back. And it doesn't have to be the money. You can keep the money, okay? But here's what I'd love for you to give back. I'd love for you to just take your mouse and click on that little subscribe button right there. That's right. And then smash the little bell that's up top. It's always good to ask twice instead of once because three's the charm. With that being said, folks, thank you for joining us. And if you enjoyed this video, check that one out right there. How to design an IBC policy updated. We'll see you next time.